So, on May 6th, 2026, the global oil market essentially stared over a cliff,
Yeah, it really did.
and the Japanese yen spiked out of, absolutely nowhere, and artificial intelligence basically swallowed the stock market whole,
Right. And all of that happened within a single 24-hour window.
which is wild. Welcome to the deep dive, by the way. We're so thrilled to have you with us today.
Yeah, thanks for joining us.
This deep dive is tailored specifically for you, the learner, the person who really wants to cut through all the frantic, contradictory breaking news alerts.
Because there are a lot of them right now.
Oh, absolutely. We want to extract the actual underlying mechanisms that are driving the world right now.
Right, because the headlines only tell you what happened. We're here to figure out how it happened, why it happened, and how these seemingly isolated events across the globe are actually intimately connected.
Exactly. And to accomplish that, we've pulled together a massive stack of source materials today.
We really have.
Yeah, we are looking at granular market analyses from financial firms like AMD and Saxo.
And those are the institutions that are actively tracking currency flows, right? And commodity pricing.
Yep, exactly. Plus, we've got deep financial commentary from StoneX and Fidelity. For the geopolitical side, we are pulling on the ground reporting from Al Jazeera.
And to anchor all of this, to really ground it, we are diving into macroeconomic data, ranging from the U.S. Bureau of Labor Statistics all the way to Chinese industrial output metrics provided by the ITIF Hamilton Index.
So it's a huge stack. And if you had to synthesize all of those sources into an overarching theme, what would you say we're witnessing?
I mean, I would call it the great de-escalation.
Okay, the great de-escalation.
Yeah, we had this sudden moment where a potential diplomatic breakthrough between the United States and Iran acted as like a massive pressure release valve.
Right.
And that single geopolitical pivot triggered a synchronized global market rally. But, underneath that immediate sense of relief, our sources point to a profound long-term structural shift.
Which is what we really want to get into.
Exactly. We are looking at a fundamental reordering of how artificial intelligence is valued, plus a stark bifurcation in domestic consumer spending.
In a pretty quiet but brutal war over the physical materials that power global trade.
Yeah.
Okay, let's unpack this, because to understand why the stock market just exploded to the upside, we have to start with the catalyst.
Right, the trigger.
Yeah, we have to look at the sudden, totally unexpected shift in the U.S. and Iran conflict.
Because you simply cannot understand the technology rally or the currency rotations we saw without first understanding the mechanics of what just happened in the Strait of Hormuz.
So let's set the stage for anyone who hasn't been following the military movements minute by minute, because it's been intense.
It really has.
Up until this week, we were looking at a highly escalated, incredibly tense situation. The U.S. had initiated what they called Project Freedom,
Right.
which was this massive naval escort operation. I mean, the goal was to physically break the Iranian blockade in the Persian Gulf.
We had warships, we had anti-air batteries tracking drone swarms. I mean, the whole 9 yards.
The whole 9 yards. And then, abruptly, President Trump posts on Truth Social that the entire operation is being paused.
Paused to allow for a 30-day negotiation window.
Just paused out of nowhere.
Yeah. And the administration specifically cited a request from Pakistan, noting that there was, great progress being made toward a complete agreement.
Right.
And shortly after that, Secretary of State Marco Rubio essentially declared the active military phase concluded.
Wow.
He stated that the U.S. is now seeking a one-page memorandum of understanding, or an MOU.
Which is a staggering pivot considering the apocalyptic rhetoric we were hearing just a few weeks prior.
It's a complete 180.
It really is.
Yeah.
And before we go any further, I want to be incredibly clear with you, our listener, right up front. Our goal here today is to impartially analyze the market.
Exactly.
We're looking at the flow of capital and the strategic impacts of these events. We are not here to take a political side or endorse any nation's foreign policy.
We are strictly looking at the facts on the ground and how the global economy is reacting to them.
Right. So let's look at the mechanics of this diplomacy. How did we get from naval standoffs to an ENGMO?
Well, the fulcrum of this entire shift is Pakistan.
Okay.
We've seen Pakistani Prime Minister Shehbaz Sharif, working very closely with Saudi Crown Prince Mohammed bin Salman, step up as the primary mediators here.
Yeah, I've been busy.
Very busy. They have been aggressively shuttling proposals back and forth between Washington and Tehran.
Why Pakistan, though? What makes them the effective broker in this specific situation?
It really comes down to geopolitical leverage in geography.
Okay, unpack that.
So Pakistan shares a massive, highly porous border with Iran, but they also have deep, long-standing security and economic ties with Saudi Arabia and the United States.
Ah, I see.
So they're uniquely positioned to talk to all parties without being entirely beholden to any single one.
That makes a lot of sense.
Yeah. And through their mediation, we saw two very distinct competing proposals emerge. The U.S. put forward a comprehensive 14-point plan,
Okay.
and Iran countered with a 10-point plan.
And from what we've seen in the sources, those plans look fundamentally incompatible on the surface.
They do, yeah.
Let's walk through the demands. What does the U.S. want?
The U.S. 14-point framework is heavily focused on long-term containment.
Okay.
It demands a 12-year moratorium on all nuclear enrichment above civilian grade levels.
Which is a huge demand.
Massive. It also requires the immediate reopening of the Strait of Hormuz backed by international security guarantees.
Right.
And finally, it demands that Iran hand over its existing stockpiles of highly enriched uranium.
Okay, so that's the U.S. side, whereas the Iranian 10-point plan is almost entirely focused on immediate economic relief.
And territorial sovereignty, yes.
Right, so they want an immediate end to the military escalation.
Naturally.
And they are demanding international recognition of their sovereignty over the Strait of Hormuz, which, crucially, includes the right to collect tolls for commercial passage.
Right, they want to monetize the strait.
Exactly. Plus, they want the full, unconditional release of all their frozen assets currently held in foreign banks.
And here's the real sticking point. They want any discussion regarding their nuclear program entirely decoupled from this immediate ceasefire.
They want it pushed to a later date.
Exactly. They want to deal with the immediate trade and economic issues now and the nuclear stuff later.
And that last point seems to be the linchpin.
It really is.
Because the market absolutely breathed a sigh of relief when it became clear that the U.S. might actually be willing to accept that specific sequencing.
Right. The idea of, deal with the Strait of Hormuz today, deal with the nuclear enrichment issue tomorrow.
Let's dig into why that sequencing is so vital to the global economy. What is the actual mechanism that makes the Strait of Hormuz so critical?
It is a quotient of physical choke points and insurance mathematics.
Okay, math. I love it. Break it down.
So the Strait of Hormuz is incredibly narrow. It's only about 21 miles wide at its narrowest point.
That's practically a river.
It really is in terms of naval navigation. Yet it facilitates the transit of roughly 20% of the world's global energy supply.
Wow.
Millions of barrels of oil pass through there every single day.
And when Iran initiated this blockade, they didn't just line up warships wall to wall.
No, they used the sea denial strategy.
Let's explain that.
Sure. Sea denial in the 21st century relies on asymmetric warfare.
Okay.
We're talking naval mines, autonomous drone swarms, and fast attack craft.
Which I imagine is relatively cheap to deploy.
Exactly. It's very cheap to deploy, but incredibly difficult and expensive to defend against.
Right.
And the true brilliance, or rather the true disruption, of a sea denial strategy is that it doesn't need to physically sink every ship to close the strait.
What does it need to do?
It just needs to alter the actuarial math of the insurance companies.
This is where the plumbing of global trade gets fascinating. Let's explain how marine insurance actually dictates global energy flows.
Right. So if you are operating a massive, very large crude carrier.
One of those giant supertankers.
Exactly. A ship that costs hundreds of millions of dollars, carrying a cargo worth hundreds of millions more. You cannot move that vessel without insurance.
Obviously.
You need hull and machinery insurance, and you need cargo insurance.
Okay.
When the sea denial strategy began, the risk of a drone strike or a mine became so statistically probable that the traditional insurance syndicates—
Places like Lloyd's of London.
Yes, exactly. They simply stopped underwriting policies for that region.
So the war risk premiums just went to infinity.
Effectively, yes.
Yeah.
The market completely shut down. And if you cannot insure the cargo, the shipping companies will not sail.
They won't risk it.
No.
Yeah.
So, by blockading the insurance market, you blockade the physical oil.
That is wild.
So when the U.S. signaled a willingness to negotiate an MOU that prioritizes reopening the strait, even if it means shelving the nuclear demands for now, they sent a massive flashing green light to the marine insurance market.
They signaled that the risk premiums could begin to normalize.
Right, and that the physical flow of oil is about to resume.
I mean, I understand why the market is cheering, but I have to introduce some skepticism here.
Go for it.
Looking at the situation, is this actually a resolution? Or is it more like installing a pressure release valve on a boiler that's still fundamentally overheating?
That's a good analogy.
Because if we look at the VIX, the volatility index, which tracks the market's expectation of future turbulence, it definitely dropped.
It did.
It went down into the 17.38 range, somewhere around there. But a VIX of 17 is still noticeably elevated compared to the baseline before this conflict began.
Yes, it is.
So the market is rallying, but it seems to be keeping one hand on the ripcord.
That is a very astute observation, and it brings up a crucial distinction in how financial markets operate.
Okay, lay it on me.
Markets do not price in absolute permanent geopolitical peace.
Right.
They price in probabilities.
Probabilities, okay.
Right now, the market is pricing out the tail risk of an absolute supply cliff scenario.
The nightmare scenario.
Exactly. The scenario where 20% of global oil goes offline indefinitely.
Which would be catastrophic.
It would be. So the VIX remaining elevated tells us that institutional investors know the underlying tensions haven't vanished.
The boiler is still hot, like I said.
The boiler is very hot, but the immediate threat of the boiler exploding today has been removed.
Got it. And that removal of immediate panic directly feeds into the most aggressive reaction we saw across all our sources.
The violent repricing of the global commodities market.
Yes. We saw oil prices absolutely fall off a cliff.
Life's dramatic.
For weeks, Brent crude had been trading with this massive war premium, sitting well above $120 a barrel.
Right.
But on the news of this MOU, it plummeted. It dropped nearly 8% in a single session.
To be precise, Brent crude dropped to $101.27.
Wow.
Which represents a 7.8% decline, and West Texas Intermediate, the U.S. benchmark, fell 7% to $95.08.
And in the world of global commodities, a single-day repricing of that magnitude is seismic.
It really is.
But the ripple effects didn't stop at oil. Over in the precious metals market, spot gold did something that seems incredibly counterintuitive.
Oh, this was fascinating.
It surged past $4,700 an ounce, hitting multi-week highs.
Yeah.
At the same time, we saw the U.S. dollar weaken significantly across the board. And then, almost out of nowhere, the Japanese yen mounted this massive rally against the dollar.
The yen rallied 1.8%, bringing it to around 155 per U.S. dollar.
Right. So we have oil crashing, gold spiking, the dollar falling, and the yen rallying, all occurring in the exact same 24-hour window.
It's a lot to take in.
It is. So for a listener trying to make sense of their portfolio or just trying to understand the global economy, how do all these disparate movements connect?
Let's trace the flow of capital logically, starting with oil.
Okay.
A 7% drop in crude oil prices acts as a massive, instantaneous stealth stimulus for the global economy.
Let me pause you there. Explain the mechanics of a stealth stimulus.
Sure. Think about a nation like Japan or South Korea.
Okay.
They are advanced industrial economies, but they lack domestic energy resources.
Right. They have to import basically everything.
Exactly. They import nearly all of the crude oil and liquid natural gas they consume. When oil is at $120 a barrel, a massive amount of their national wealth is hemorrhaging out of the country just to keep the lights on and the factories running.
Just paying the energy bill.
Exactly. But when the price of oil drops by nearly $10 a barrel overnight, that hemorrhage slows dramatically.
Right.
Their national trade deficit shrinks instantly. Capital that would have been spent on fuel can now be redirected.
Into domestic investment, corporate profits, or consumer spending.
You got it. Furthermore, cheaper energy instantly lowers global inflation expectations because the cost of transporting every single good on the planet just went down.
Which brings us back to the Japanese yen. If their economy is getting this massive relief from cheaper oil, their currency naturally strengthens.
That is part of it. But the yen's sharp rally to 155 per dollar wasn't entirely organic.
Oh.
Our sources, particularly the analysts at AMD and StoneX, strongly suspect we witnessed stealth intervention by Japanese authorities.
I have always found that term fascinating, stealth intervention. What does that actually look like in practice? Because it's not like the Bank of Japan issues a press release saying, hey, we are buying our own currency.
Far from it. When a central bank wants to prop up its currency without causing a panic or, drawing speculators into a fight, they operate through proxies.
How so?
The Bank of Japan will quietly instruct a network of correspondent banks to aggressively buy yen and sell U.S. dollars during off-peak trading hours.
often when liquidity is thinnest.
Exactly.
So they do it to maximize the impact of every dollar they spend.
Precisely. They execute these massive algorithmic block trades to create a sudden upward spike in the yen's value.
Okay.
And this upward spike triggers the automated stop-loss orders of hedge funds that were betting against the yen.
Ah, so it's a trap.
Kind of. When those stop-losses trigger, the hedge funds are forced to buy yen to cover their positions.
Which pushes the price up even further.
The central bank lights the match, but the automated market plumbing creates the fire.
That is brilliant.
And in this case, that intervention was massively aided by the broader weakening of the U.S. dollar.
Because for the last several months, the dollar has been acting as the ultimate safe haven.
Exactly.
Whenever bombs are flying, global capital flocks to the safety of U.S. treasuries, which requires buying dollars.
Right.
But once this MOU was announced and the fear dissipated, that geopolitical premium on the dollar just evaporated. Capital started looking for a new home.
Which leads us directly to the paradox of the gold market.
Yes. Let's dive into this because this breaks traditional financial logic.
It really does.
Normally, gold is the ultimate fear asset. If inflation is out of control or if a war breaks out, people buy gold.
Right.
But here, the geopolitical fear just dropped significantly. We have a de-escalation. By all historical metrics, gold should have sold off.
It should have.
Instead, it spiked over 3%. Why?
It comes down to the mechanics of currency pairs and relative value.
Okay, unpack that.
You are absolutely right that the geopolitical fear premium vanished. However, gold is priced globally in U.S. dollars.
Okay.
As we just established, the sudden peace news caused the U.S. dollar to drop rapidly.
Right.
When the currency used to measure the value of gold weakens, it takes more of those weaker dollars to buy the same ounce of gold.
So it's an optical illusion. Gold didn't actually become more valuable. The measuring stick just shrank.
It's partly mathematical, yes, but it is also driven by massive capital rotation.
How so?
Institutional investors had billions parked in U.S. dollars for safety.
Right.
When the dollar started sliding, they had to rotate that capital somewhere else to preserve its purchasing power.
I see.
They didn't buy gold because they were afraid of a war in the Strait of Hormuz. They bought gold because they needed a hard asset to hedge against a rapidly depreciating U.S. currency.
Wow. So it was a purely structural rotation, completely divorced from the emotional fear of conflict.
Exactly.
That makes perfect sense. But looking at the broader stock market, I want to explore how this energy crash actually filters down to specific companies.
Let's do it.
Because we saw the broader markets explode, but major energy producers, companies like Suncor and Enbridge, actually took a significant hit.
They did.
Now, I read their earnings reports. Suncor posted solid numbers. Why did their stock get punished on a day when the broader market was euphoric? I mean, if oil drops, my gas is cheaper, which acts like a tax cut for me, so what gives?
What's fascinating here is that the stock market is a forward-looking discounting mechanism.
Meaning what?
It doesn't care what you earned yesterday.
Yeah.
It only cares what you will earn tomorrow.
Okay.
For energy producers, their profit margins are inextricably tied to the price of the underlying commodity.
Oil.
Right. Suncor's strong earnings were based on selling oil at those elevated war premium prices.
$120 oil.
Exactly. When investors saw oil drop 7% in a single day, they immediately recalculated Suncor's future cash flows based on $95 oil instead of $120 oil.
So the math just changed instantly.
Yes. The entire inflation hedge trade, where investors hide in energy stocks to protect against rising prices, began to rapidly unwind.
And we know exactly where all that unwound capital went.
We do.
It rushed like a tidal wave into the technology sector.
It certainly did.
Which brings us to the most explosive, reality-bending part of this entire deep dive, the artificial intelligence supercycle.
Oh, yeah.
With the inflation bogeyman of high oil prices temporarily vanquished, the global stock indices went utterly parabolic.
The scale of the movement in the technology sector is honestly difficult to overstate.
The trends are staggering. We watched the S&P 500 blast through previous ceilings to close at a new record.
Right.
The tech-heavy Nasdaq surged wildly. But it wasn't just a U.S. phenomenon.
No, not at all.
The Asian markets reacted with incredible violence. We saw South Korea's primary index, the Keiko SPI, surge massively in a single session.
And Japan's Nikkei followed suit.
Exactly. And when you look under the hood of these indices, it is entirely driven by the semiconductor ecosystem.
Let's put some precise numbers to those trends just to give a sense of scale.
Please do.
The S&P 500 closed at a record 7,365.12, up 1.5% on the day.
Huge.
The Nasdaq hit 25,838.94, a 2% jump.
Insane.
And in Asia, the Keiko's PI surged an astonishing 6.45%, and the Nikkei jumped 5.58%.
And the individual corporate earnings driving those index numbers are just as wild.
Oh, absolutely.
We saw AMD crush their Q1 estimates. They posted over $10 billion in revenue with an EPS of $1.37. That sent their stock soaring 18.6%. And Supermicro, which builds the actual server racks for these AI chips, saw their stock jump 24.5%.
It's massive. And then there's Samsung.
Yes, Samsung Electronics crossed a massive psychological and financial threshold in Seoul.
They achieved a $1.03 trillion market capitalization.
$1 trillion.
Yes. To see a non-U.S. hardware manufacturer cross the trillion-dollar threshold is a testament to the structural shift we are analyzing.
It really is.
What we are observing is the technology sector fundamentally decoupling from broader macroeconomic anxieties.
Let's break down that decoupling, because historically, tech stocks are incredibly sensitive to interest rates.
They are what we call long-duration assets.
Right, so if the Federal Reserve raises rates, borrowing costs go up, future earnings are discounted more heavily, and tech stocks usually plummet.
That's the traditional model, yes.
But right now, interest rates are still relatively high, yet tech is completely ignoring gravity. How did this AI supercycle sever that historical link?
It all comes down to the CapEx logic, the capital expenditure logic of the entities we call the hyperscalers.
Okay, define hyperscalers for us. Who are they?
Hyperscalers are the massive cloud computing providers. We are talking about Microsoft Azure, Amazon Web Services, Google Cloud, and Meta.
The big boys.
The biggest. These companies operate data centers on a scale that is almost incomprehensible.
Okay.
Traditionally, when interest rates went up or the economy slowed down, corporate IT budgets would get slashed. Companies would delay buying new servers.
That's the classic boom and bust cycle of the semiconductor industry.
Exactly. But artificial intelligence has changed the calculus entirely.
How so?
The hyperscalers no longer view spending on AI infrastructure, specifically the advanced GPUs and high-bandwidth memory chips required to train these massive neural networks. They don't view it as discretionary spending anymore.
It's not a nice to have.
No, it is no longer an IT upgrade. It is an existential arms race.
Because if Google stops buying chips for 6 months, Microsoft leaps ahead.
And Google's core search business could be rendered obsolete.
Wow.
Precisely. They do not care if interest rates are at 4% or 6%. They don't care if consumer spending is slightly down.
It doesn't matter.
It doesn't. If they stop spending billions on AI infrastructure, they lose their position in the future economy.
Period.
Period. This relentless, price-insensitive demand from the hyperscalers has created a guaranteed revenue floor for the hardware providers like AMD, NVIDIA, and Samsung.
Here's where it gets really interesting. I want to try an analogy here to see if I'm grasping the scale of this.
Go.
In previous tech booms, like the dot-com era, we talked about selling pickaxes during a gold rush, right?
A classic analogy.
Cisco sold the routers, and everyone else mined for the internet gold.
Right.
But this feels fundamentally different. It's as if, instead of thousands of individual, scrappy miners buying a few pickaxes each, you have 3 or 4 sovereign nations and trillion-dollar empires trying to buy every single pickaxe on the planet simultaneously.
That's a great way to put it.
And they are willing to pay whatever price the blacksmith asks, just to ensure their rival doesn't get the tool. And AMD, Samsung, and Supermicro, they are the only blacksmiths in town.
That is a highly accurate way to visualize the market dynamics right now.
It's crazy.
Semiconductors have transcended their previous status. They're no longer a cyclical commodity. They have become the foundational utility of the 21st century.
A utility, like water or power.
Exactly. Just as you could not run an industrial economy in the 1920s without a reliable electrical grid, you cannot run a modern digital economy without high-bandwidth memory chips from SK Hynix or GPUs from AMD and NVIDIA.
But I have to look at the other side of this coin.
Of course.
When you look at the South Korean market specifically, the concentration is terrifying.
It really is.
The top chip makers now account for nearly 50% of the entire KOSPI market capitalization.
Half.
Half of the value of their entire national stock exchange is concentrated in the product cycles of a few microchips. Isn't that level of concentration inherently fragile?
It is the very definition of macroeconomic fragility.
Right. What happens if there's a manufacturing defect at a Samsung fabrication plant?
When you have that level of concentration, a localized corporate issue becomes a national economic crisis.
That's what I'm thinking.
If a fab goes offline due to a power grid failure, or if a next-generation chip architecture fails to yield properly, it doesn't just hurt that specific stock.
Right.
It drags down the index, which impacts domestic pension funds, which hurts consumer confidence, which slows the entire South Korean economy.
Wow.
You are tying the health of a sovereign nation to the delicate physics of printing circuits on a silicon wafer.
And it isn't just financial or manufacturing fragility.
No.
The source materials provided a profoundly sobering reality check regarding the technology itself.
This cyber risk.
Yes,
Yeah.
because the very same AI that is driving these trillion-dollar valuations carries unprecedented systemic risks.
You are referring to the stark warning issued by the International Monetary Fund.
Yes. Amidst all this market euphoria, the IMF released a report warning that artificial intelligence is directly fueling a new era of sophisticated cyber attacks.
Right.
They specifically highlighted a specific AI model known as the Claude Mythos.
A very advanced model.
Very. The IMF identified this model not as a helpful coding assistant, but as a massive systemic risk to the global financial architecture.
This brings us to the concept of the dual-use paradox in artificial intelligence.
Let's break down the mechanics of that. How does an AI model actually become a systemic threat? What is Claude Mythos doing that a human hacker cannot do?
It comes down to scale and pattern recognition.
Okay.
The underlying technology is identical. The massive neural networks designed to ingest vast amounts of data, to write software code rapidly, or optimize logistics networks. Those exact same networks can be pointed at legacy code bases to find vulnerabilities.
We hear the term zero-day vulnerability a lot. What is the mechanism there?
So a zero-day is a software flaw that the original developer is completely unaware of, meaning they've had 0 days to patch it. Imagine the global banking system. Much of it runs on decades-old code, layered on top of newer code, creating a labyrinth of dependencies.
Spaghetti code.
Exactly. Human security researchers can only audit so many lines of code per day.
Naturally.
But an AI model like Claude Mythos can ingest the entire architecture of a bank or operating system in seconds.
In seconds.
It maps every single dependency and runs millions of simulated interactions, looking for a logic error or a backdoor that a human eye would never catch.
So it's like we're building a hyper-efficient, fully automated banking system, but the contractor building the vault is also accidentally printing master keys and leaving them on the sidewalk.
That is exactly it. It's automating the discovery of the master keys.
That is terrifying.
And once it finds that vulnerability, it can automatically generate the exploit code required to bypass the security.
Wow.
The IMF is terrified because the barrier to entry for conducting a devastating cyber attack has plummeted.
You don't need to be a genius hacker anymore.
Right. A non-state actor no longer needs a team of elite hackers. They just need access to a sufficiently powerful, poorly aligned AI model.
If I connect this back to our earlier discussion about the market, it creates a massive cognitive dissonance.
It does.
We have the stock market hitting all-time highs because AI is going to make every corporation hyper-efficient.
Right.
But simultaneously, the IMF is stating that this exact same AI could be used to compromise the integrity of the banking system itself.
Yes.
How are the financial markets pricing in this catastrophic risk?
The blunt reality is that they are not pricing it in at all.
How is that possible? If the IMF is flagging it as a systemic risk, why doesn't it show up in the valuations of these tech companies?
Because financial markets are structurally terrible at pricing in unprecedented binary tail risks.
What do you mean by binary tail risk?
Markets excel at pricing in linear changes. If consumer spending drops by 2%, the market can perfectly calculate the impact on retail stocks. But a black swan cyber event, say, an autonomous algorithm taking a major clearinghouse offline for 3 days, is a binary event.
It either happens or it doesn't.
Exactly. It either hasn't happened or it is currently destroying the system. Until it actually occurs, the market ignores it.
They just put their blinders on.
They price in the infinite upside of AI productivity and assign a probability of 0 to the systemic collapse scenario.
That is a terrifying blind spot.
It really is.
And it serves as a perfect pivot because we need to bring this high-flying trillion-dollar AI discussion back down to the ground level.
Back to the real economy.
Yes. We need to look at the domestic U.S. economy, the actual plumbing of the financial system, and the people buying goods in May of 2026.
Let's look at the actual data.
Because the macroeconomic data paints a picture of an economy that is highly complex and deeply bifurcated.
Very bifurcated.
Let's start with the U.S. labor market. On a surface level, things look incredibly stable. Unemployment is holding remarkably steady. The economy is still adding jobs.
Right, 4.3% unemployment.
But when you disaggregate the data, it's a very mixed bag. We saw the healthcare and construction sectors absolutely booming, hiring tens of thousands of workers.
Yes.
But simultaneously, the federal government sector is bleeding out.
The numbers reveal the nuance. The U.S. economy added 178,000 jobs overall, keeping that national unemployment rate at 4.3%.
Okay.
However, the federal government shed 355,000 jobs.
Which had a massive localized impact. The unemployment rate in Washington, D.C. spiked 6.3%, making it the highest in the entire nation.
Exactly.
So we have construction booming, government shrinking. What does this tell the Federal Reserve?
It tells them they have achieved the classic Goldilocks scenario.
Okay, the porridge is just right.
Exactly. The economy is not running so hot that inflation will spiral out of control. We see that cooling effect in the government job losses and the slightly lower than expected job openings in the JOLTS report, which tracks labor turnover.
But it's also not freezing over into a recession.
Precisely. It is cooling, but it is not cracking.
So what does the Fed do?
For the Federal Reserve, this is the perfect cover to simply do nothing.
Just wait.
They can pause their rate hike cycle, hold interest rates exactly where they are, and let the economy gently coast, waiting for more definitive data.
And while the Fed sits on its hands, the U.S. Treasury is actively managing the gears of the system.
They are very busy.
We saw the Treasury announce a massive quarterly refunding, issuing bonds across 3, 10, and 30-year notes.
Right, $125 billion refunding.
Right. And nestled inside that announcement was a highly technical detail that caught my eye.
The repo specialness.
Yes. The Treasury announced a shift in the settlement dates for their 20-year bonds, specifically to, quote, mitigate repo specialness.
Unquote, yeah.
Now, for the listener who isn't a bond trader on Wall Street, let's demystify this. What is the repo market? What makes a bond special? And why is the Treasury altering its schedule to fix it?
It sounds like impenetrable financial jargon, but the underlying mechanism is actually quite straightforward.
Okay, lay it out.
The repo market, short for repurchase agreements, is essentially the pawn shop of the global financial system.
The pawn shop. Okay, explain how that pawn shop works.
Imagine a massive hedge fund. They have billions of dollars tied up in long-term investments, but they suddenly need $1 billion in cash overnight.
Maybe to meet a margin call or fund a new trade.
Exactly. They can't just go to an ATM. Instead, they go to the repo market.
Okay.
They hand over an incredibly safe asset, like a U.S. Treasury bond, to a bank as collateral, and the bank gives them cash for the night.
Just for one night.
Right. The next morning, the hedge fund buys the bond back at a slightly higher price. That price difference is the interest rate.
Okay, so the bond is just collateral. It's just sitting there. Why does the specific type of bond matter? Why did the 20-year bond become a problem?
Because sometimes a specific issue of a bond becomes highly sought after. Perhaps a lot of traders have shorted the 20-year bond, meaning they bet the price would go down, and now they desperately need to borrow that specific bond to cover their bets.
Ah, I see.
When demand for that specific bond skyrockets, but the supply is limited, the bond becomes special.
Special. And when something is special, the rules change.
Exactly. Because the banks know traders are desperate for that specific 20-year bond, the banks will accept an artificially low interest rate on the cash they lend out, just to get their hands on that collateral.
Because they know they have the leverage.
Right. And this distorts the entire interest rate market.
So how does the Treasury fix it?
By shifting the settlement dates of these bond auctions, the Treasury is actively injecting more supply of the 20-year bond into the market precisely when it's needed.
Ah.
They are acting as the mechanic, lubricating the plumbing of this $30 trillion debt machine to ensure borrowing costs remain stable.
It's fascinating how much active management goes into just keeping the baseline functioning.
It's a full-time job.
So the macro plumbing is stable. But what about the actual consumer? Because when we look at corporate earnings, we see two entirely different realities coexisting.
You are referring to the corporate data from Disney, Marriott, Whirlpool, and Shopify.
Yes, the divergence is stark.
It is.
On one end, Disney's premium streaming margins just hit 10%. Marriott reported their revenue per available room is up 4.2%, driven heavily by an influx of Chinese high-net-worth travelers booking luxury suites.
Right.
So the premium travel and entertainment sectors are absolutely thriving. But then you look at Whirlpool, the appliance manufacturer,
And their margins have completely collapsed.
to almost zero.
The Whirlpool margins dropped to 0.3%, to be exact.
Wow.
This data perfectly illustrates what economists define as the K-shaped consumer reality.
Let's visualize that. How does the K-shape explain what's happening to the average consumer?
Imagine the letter K. The vertical line represents time, and the two arms jutting out represent the trajectory of different economic classes. The arm pointing upward represents the high net worth consumer.
The ones booking the Marriott suites.
Exactly. These individuals are largely insulated from macroeconomic headwinds. A 4.3% unemployment rate or a 6.5% mortgage rate does not materially impact their daily lives.
Because their wealth is tied to assets.
Like the booming stock market we just discussed.
Right.
They are flush with capital, and they are spending it freely on premium experiences, upgrading their Disney packages, and booking international flights.
They are entirely driving that top-line growth.
Yes.
And the arm of the K pointing downward.
That is the middle market consumer.
Okay.
This is the individual who relies on wages rather than asset appreciation. They are feeling the full, crushing weight of elevated interest rates.
So what happens when their washing machine breaks?
They don't have the cash on hand to replace it. They have to put it on a credit card, charging 22% interest. Because the cost of borrowing is so punitive, this consumer is completely tapped out. They are deferring every single big-ticket purchase they can.
Which explains why Whirlpool can't sell appliances without slashing their prices to the bone, thereby vaporizing their profit margins.
Precisely. The economy overall is growing, but the benefits of that growth are deeply bifurcated.
And this ruthless environment isn't just applying to consumers, it's applying to the companies themselves. Let's look at Shopify.
Okay.
So what does this all mean for them? I want to dig into the mechanics of their stock drop because it feels totally counterintuitive.
It does, on the surface.
I looked at Shopify's earnings report. They beat their revenue estimates. They beat their profit estimates. By all traditional metrics, it was a good quarter.
Right.
Yet, Wall Street punished them with a massive sell-off, dropping the stock by over 15%. Why?
Because the market regime has fundamentally changed.
How so?
In the era of 0% interest rates, investors would happily pay a massive premium, a high multiple, for a stock like Shopify, purely based on the promise of top-line revenue growth.
They didn't care about profitability.
They just wanted market share, growth at all costs.
Right.
But in 2026, money is no longer free. Investors demand operating leverage.
Break down operating leverage for us.
Operating leverage means that for every new dollar of revenue you bring in, a larger percentage of it falls straight to the bottom line as profit.
Okay.
Investors are looking at these companies and saying, we know you have access to incredible AI tools. We expect you to use those tools to become radically more efficient.
They want to see revenue growing while headcount and operating costs actually shrink. So beating estimates isn't enough anymore. You have to prove the AI is actually replacing your costs.
Exactly. Shopify provided forward guidance that suggested their costs would continue to grow alongside their revenue. They didn't demonstrate enough of that flawless AI-driven efficiency. When you are priced for perfection, any indication that you are operating like a traditional labor-intensive company will trigger a massive re-rating.
So Wall Street didn't punish their past performance, they punished their future inefficiency.
You hit the nail on the head.
It is a ruthless standard.
It is.
And speaking of ruthless long-term realities, we need to zoom out for our final segment here.
Let's look at the big picture.
We have spent this deep dive analyzing the U.S. consumer, the immediate impact of the Middle East peace deal, and the software side of the AI boom.
Right.
But the sources point to a massive structural tectonic shift happening right underneath our feet.
A shift in global trade hegemony.
Yes, that goes far beyond any single software company.
If we pull all these threads together and connect them to the macroeconomic picture, the data coming out of the ITIF Hamilton Index 2026 is arguably the most consequential information we have discussed today.
Let's look at what the index is actually measuring.
Yeah.
It tracks advanced industry output, the high-value manufacturing that actually drives geopolitical power, and the numbers reveal a changing of the guard.
Massive change.
According to the index, China now officially accounts for 24.9% of the world's advanced industry output. They have surpassed the United States, which currently sits at 22.3%.
And the disparity becomes even more alarming when you drill down into the foundational sectors.
Sure.
China doesn't just assemble products. They control the base layer. They now control a 40% share of global basic metals output and 33% of global machinery production.
What are the practical implications of controlling 40% of the world's basic metals? I mean, that sounds huge, but what does it mean in practice?
It gives you absolute leverage over the global supply chain.
Cop.
China is actively weaponizing this dominance through a strategy we call resource diplomacy.
Resource diplomacy.
Yes. For example, they recently announced the elimination of tariffs for 53 different African nations.
On the surface, that sounds like a benevolent trade policy, right? Like they're just helping out developing nations.
It is a highly calculated geopolitical maneuver.
Oh, of course.
By opening their massive domestic market to African goods tariff-free, Beijing is securing exclusive long-term pipelines for critical minerals.
Specifically copper, cobalt, and lithium.
Exactly. These are the physical elements required to build everything from electric vehicle batteries to the data centers powering the AI models we discussed earlier.
They are systematically locking up the raw materials before anyone else can get them.
Yes.
And this is in direct competition with Western efforts, right? We've seen the U.S. and European nations trying to counter this by funding projects like the Libido Corridor in Africa.
Yes, the Libido Corridor is a massive railway infrastructure project.
Right.
It's designed to transport critical minerals from the Democratic Republic of Congo and Zambia straight to the Atlantic Ocean.
Bypassing Chinese-controlled logistics hubs entirely.
Exactly. What we are witnessing across the globe is the total securitization of trade.
Explain how the securitization of trade changes the way corporations and governments operate, because it sounds like a paradigm shift.
It is. For the last 30 years, the era of hyperglobalization was driven by a single variable, efficiency.
Finding the cheapest labor.
Right. Corporations asked, where can we source this material the cheapest, and where can we assemble it the fastest?
And the answer was almost always China.
Exactly. But that era is definitively over. Today, economic trade is viewed almost exclusively through the lens of national security.
Wow.
Trade is no longer about cost optimization. It is about strategic control and redundancy.
Because if a nation controls all the cobalt, they can simply flip a switch and shut down your domestic electric vehicle industry.
Exactly. China is cementing itself as the inescapable hub of the 21st century economy by hoarding the rare earth minerals required for both the green energy transition and the AI supercycle.
And the rest of the world is realizing they are dangerously behind.
Very behind.
We saw the G7 trade ministers meet in Paris, and their concluding statement was remarkably aggressive. They explicitly vowed to take coordinated action against, quote, economic coercion.
But words are just words. The actions of Japan are far more telling.
Right. Tell me about Japan.
Japan is so concerned about their lack of access to these critical minerals that they are fundamentally altering their post-World War II pacifist posture.
That is massive.
They are lifting defense export restrictions, and they are investing heavily in highly experimental seafloor mining.
Just to find their own independent source of rare earth materials.
They understand the fundamental truth of the new era. Whoever controls the physical resources controls the geopolitical future.
I want to make this connection crystal clear for you, the listener, because this brings everything full circle.
It really does.
We spent the whole deep dive talking about software, AI, and cloud computing. We marveled at autonomous AI finding zero-day vulnerabilities and hyperscalers generating trillion-dollar valuations out of thin air. But at the end of the day, the cloud is not a vapor. The cloud is made of metal.
A profound reality. The digital world requires massive physical infrastructure.
Exactly. The cloud is millions of miles of copper wire, massive aluminum cooling systems, and hyper-complex silicon microchips.
Yes.
The United States might employ the software engineers who design the world's most brilliant AI algorithms, but China is systematically locking down the physical metals and rare earth elements required to actually build the machines that run those algorithms.
It is the ultimate physical constraint on digital infinite growth.
And that profound tension between the nation that commands the software and the nation that controls the metal ensures that this global rivalry is going to remain a massive, ongoing source of volatility for markets for decades.
Absolutely.
It doesn't matter if we get a temporary peace deal in the Strait of Hormuz. This deeper structural conflict is baked into the system.
It is the defining geopolitical reality of the coming decade, and it will influence every major capital allocation decision from here on out.
So let's take a breath and summarize the massive journey we have been on today.
It's been quite a ride.
We started in the choke point of the Strait of Hormuz, where a complex Pakistan-mediated MOU between the U.S. and Iran created a fragile, temporary hope for peace.
And that geopolitical relief valve dramatically altered the marine insurance market, which crashed global oil prices.
And that crash acted as a stealth stimulus, sending a tidal wave of liquidity rotating out of the U.S. dollar and into alternative assets like gold, while prompting stealth intervention in the Japanese yen.
And crucially, that liquidity supercharged the AI semiconductor rally, pushing major indices to record highs.
As hyperscalers continued their price-insensitive buying spree, even as institutions like the IMF sounded the alarm about the systemic, unpriced cyber risks inherent in the AI models themselves.
We brought those lofty valuations back to reality by examining the bifurcated, K-shaped U.S. consumer.
Where high-end travel booms while the middle class is crushed by interest rates, and where companies are punished ruthlessly for failing to demonstrate AI-driven operating leverage.
And looming over all of this intricate financial plumbing is this stark reality of China's absolute dominance in advanced industrial output.
And the critical metals required to build the future.
It is a vastly interconnected, highly sensitive web of cause and effect.
And that is exactly why we do this, for you, the learner. Because understanding these hidden linkages, understanding how the actuarial math of a marine insurance policy in London impacts the valuation of a semiconductor plant in Seoul, well, and how that ultimately dictates the inflation data that drives the mortgage rates and retirement accounts in your own life, that is the true shortcut to being well-informed.
It is.
You can't just read the breaking news alerts. You have to understand the physical and financial gears turning underneath the headlines.
And as we consider those gears, there's a final provocative thought we should leave on the table based on everything our sources have revealed today.
What's that?
We are entering an era where traditional economic rules and historical hedges are failing us.
The old models are breaking down.
They are. Think about the contradictions we unpacked. A geopolitical de-escalation makes oil crash, but simultaneously causes gold, the ultimate fear asset, to surge.
Right.
Artificial intelligence promises infinite corporate productivity, yet introduces an existential cyber risk that the market refuses to price in.
It's totally ignored.
So the U.S. dollar and crude oil are no longer reliable gauges of global stability. The question becomes, how do we redefine a safe haven asset in a bipolar, AI-driven world?
Will the ultimate currency of the future simply be raw computing power? The ability to train a faster, more capable model than your adversary?
Or will it be the physical, unhackable rare earth minerals sitting at the bottom of the ocean required to turn that computing power on?
A battle between the algorithm and the earth. That is a heavy, fascinating question to mull over as you watch the markets open tomorrow. Thank you so much for joining us on this deep dive. Keep questioning the headlines, keep looking for the hidden connections, and we'll see you next time.